Welcome to the deep dive. Today, we're taking your sources, specifically the latest earnings call from Nutanix Inc., ticker NTNX.
Yep, NTNX.
Yeah.
Came out just yesterday, August 27th.
Exactly. And we're really going to unpack their Q4 and full fiscal year 2025 results. Our mission is to pull out the key insights for you.
Guide you through the numbers, the strategy.
And what management seems to be signaling for the future.
It's a really interesting one, actually, especially given how the market reacted almost immediately.
Right. Strong, close to the year, beat estimates.
Beat quite a few headline numbers, yeah. But then that little pullback in after-hours trading, that kind of nuanced response, that's exactly what we need to dissect, get into the underlying story and, what it implies going forward.
Okay, let's jump straight into those top-line numbers then. Give everyone the high-level view first.
Sounds good.
So, for the full fiscal year 2025, Nutanix reported total revenue of $2.54 billion. That's up an impressive 18% year over year.
Pretty solid growth there.
And ARR, annual recurring revenue, hit $2.22 billion, up 17%. Also strong.
Consistent.
But here's a big one. They achieved their first full year of positive GAAP net income, $188 million.
Yeah, that is big. First time ever on a full year basis.
What does achieving that GAAP profitability really signify for a company like Nutanix? Still in growth mode, right?
Absolutely. It's kind of a coming of age moment, isn't it? It signals they've matured beyond just chasing top line growth at all costs.
Right. It's about sustainable, efficient operations now.
Exactly. They're proving the leverage in their subscription model. They're not just, buying growth anymore. They're earning it efficiently.
And that discipline probably underpins the strong free cash flow, too, $750 million for the year.
Definitely. That leads straight to that rule of 40 score you mentioned, 48.
Which they've hit for the second year running. That's often seen as a benchmark for healthy software businesses.
It is. Hitting 48, consistently above 40, tells you they're balancing that growth and profitability really effectively. It implies a resilient business model.
Okay, and then drilling down into the fourth quarter specifically.
And 4 was also strong. Revenue came in at $653 million, nicely beating their own guidance. That's a 19% jump year over year.
And non-GAAP EPS.
Also beat expectations. Came in at $0.37 per share. So good operational performance there too.
Okay, so solid numbers all around. Growth, first-time GAAP profit, strong cash flow, beating Q4 estimates. Yet the market pulls back slightly after hours.
That's the puzzle, right?
Yeah.
It really highlights how markets work.
Yeah.
Stellar past performance met, maybe a slightly more tempered short-term outlook.
The guidance?
The guidance, we'll get to that. Investors are weighing that track record against those future projections really carefully.
Okay, so before we hit the guidance, let's unpack what drove these FY25 numbers. What were the key highlights management pointed to?
Well, on the customer front, they added over 2,700 new logos in fiscal 25.
Wow, highest in 4 years, they said.
Yeah, including over 50 from the Global 2000 list, so landing bigger fish too. Shows they can win across different segments.
And the margins really caught my eye. That expansion was pretty remarkable.
It really was. Full year non-GAAP operating margin hit 21.1%. That's up, about 5 percentage points year over year?
Yeah, roughly 5 points. For a company still investing in growth, that feels significant.
Hugely significant. It speaks volumes about their operational efficiency, the leverage in the subscription model, and non-GAAP gross margins were also super strong at 88.1%.
Very healthy.
And they also mentioned the average contract duration ticked up slightly, 3.1 years for the full year, 3.2 in Q4. That adds a bit more predictability to revenue.
Though they did flag maybe some variability there going forward.
They did hint at that, yeah.
Yeah.
Something to watch. But overall, the financial picture from FY25 looks pretty robust.
Okay, beyond the pure financials, what about the strategic progress? They talked a lot about partnerships and product innovation.
Yeah, that was a big focus. They underscored expanding alliances, with the big cloud players like AWS and Google Cloud, but also storage partners like Pure Storage and, of course, NVIDIA for AI.
Positioning for hybrid multi-cloud and AI workloads makes sense.
Totally. Like, they launched GPT in a Box 2.0, enhanced their enterprise AI platform with deeper NVIDIA integration.
And the Google Cloud support is now in public preview, right?
Correct. But one move that felt particularly strategic was enabling their platform, the Nutanix Cloud Platform, to run on existing external storage hardware.
Ah, right. Starting with Dell PowerFlex, they even mentioned some early wins there.
Exactly. That's a big deal competitively.
How so? What's the implication there?
Well, think about it. It lets them get into accounts where a customer wants to modernize, maybe move towards a private or hybrid cloud model with Nutanix.
But they have huge investments in existing storage arrays they can't just rip and replace.
Precisely. This allows them to preserve that hardware investment while still adopting the Nutanix software layer. It removes a major barrier to entry.
So it directly targets competitors, especially someone like VMware, where maybe customers are looking for alternatives now.
Absolutely. Management explicitly called out that VMware displacement opportunity, said it's still like the second innings of a multi-year game.
A lot of runway left there, they think.
A lot of runway. This external storage support, combined with their Kubernetes work and hybrid cloud focus, really strengthens their hand against VMware, especially with all the, industry consolidation and changes happening.
And speaking of wins, that Finanz Informatik deal in Germany sounded pretty major.
Oh yeah, that's a standout. A substantial multi-year deal with a large, regulated financial services provider.
They framed it as a customer looking for a stable, trusted partner amidst all the M&A noise.
Yeah, exactly. It's a huge validation. A marquee reference customer, especially in EMEA, that could really open doors.
Okay, so strong execution, strategic moves. Let's pivot to the guidance now. This seems to be where the market got a bit jittery.
Yeah, this is where that cautiously bullish label really fits. So for Q1 of fiscal 26, they're guiding revenue between $670 million and $680 million.
Okay.
And non-GAAP operating margin between 19.5% and 20.5%. Yeah.
So how does that Q1 revenue compare? Is that the slightly light part?
That seems to be the consensus view, yeah. Compared to what maybe some analysts were expecting, it looked a touch conservative. That likely fueled the after-hours dip.
And for the full fiscal year 2026?
They project revenue of $2.90 billion to $2.94 billion.
Which is about 15% year-over-year growth at the midpoint.
Roughly, yeah. Still growing, still profitable growth planned, but that 15% is a deceleration from the 18% they just posted for fiscal 25.
Ah, okay. So growth is moderating slightly in the forecast.
Exactly. And they also guided for non-GAAP operating margin for FY26 to be between 21% and 22%, so small tick up there, and free cash flow projected at $790 million to $830 million. Still strong cash generation.
But that slower top-line growth forecast may be coupled with that hint about contract duration potentially declining slightly year over year.
That's what the market is digesting. Plus, management did call out some macro uncertainties. U.S. federal spending, currency headwinds, those are baked into the outlook.
And some specific expense headwinds, too.
Yeah, about $25 million from some delayed hiring pushing into FY26, and another $10 to $15 million from some partner payments tapering off. So some known cost pressures.
Got it. And they also updated their ARR methodology. Seemed like a minor tweak.
Pretty minor, yeah. Starting Q1 FY26, they're aligning it more closely with when licenses become available for customers who defer provisioning. Mostly affects large deals. They said the historical impact is less than 2%, so it's more of a refinement for accuracy.
Okay, so putting it all together for the investor. Strong year just finished. Profitability milestone achieved. Good strategic moves. But guidance suggests slightly slower growth ahead, plus some macro caution.
That's the picture, which leads to that market pullback. The immediate reaction focused more on the slightly softer near-term guide than the strong FY25 results.
But the underlying story, the longer-term potential.
So it seems intact, right? Analysts still sound, as we said, cautiously bullish. The company is showing margin expansion, consistent cash flow, clear strategy around VMware displacement. AI is still early days, but they're positioning for it.
And they boosted their share buyback authorization quite a bit. Another $350 million.
Bringing the total available to $461 million. That signals management confidence in the valuation, gives them flexibility to offset dilution. It shows they believe the stock is a good investment.
So it's a balancing act. Scale, cash generation, investing in growth areas.
Exactly. They're watching how those partnerships, especially the external storage and AI initiatives, translate into real revenue over the next few quarters. And that Finanz Informatik win will be a key proof point.
Okay, that sets the stage perfectly for our next segment.
The This Is Not Financial Advice segment.
Precisely, where we float an outrageous but plausible trade idea for you, the listener, to chew on.
All right, let's try one. Given everything we've discussed, the solid FY25, the margins, the buyback, those long-term tailwinds like VMware and AI,
right?
Maybe that after-hours dip is an overreaction. Maybe the market focused too much on that slight Q1 guide softness.
Plausible. The full-year outlook is still decent, profitability improving.
So here's a thought. What about a long position in NTNX? Maybe target, say, the mid-$70 over the next 6 to 9 months.
Okay, going long. How do we make it outrageous but plausible?
You could layer on a long-dated call option, maybe something with a strike around $70 or $72.
Expiration date.
Thinking out maybe March or April 2026. Give it some time. The idea is you capture upside if the market starts appreciating the strategic moves more.
Especially as those Dell PowerFlex and Pure Storage partnerships gain traction.
Exactly. And as we get more clarity on that AI inflection point they mentioned, plus they announced an investor day for April 7th, 2026.
Ah, a potential catalyst?
Could be. So the call option gives you leveraged upside if the sentiment shifts from cautiously bullish back to something more firmly bullish, especially if they execute well against that FY26 plan and keep showing wins in that VMware space.
Outrageous enough.
Plausible enough, I'd say. Okay, that nicely wraps up our deep dive on Nutanix's Q4 and FY25 earnings.
Definitely a nuanced report. Strong performance looking back.
Strategic moves setting up the future, but a market keeping a very close eye on that forward guidance and execution.
Absolutely. Nutanix is clearly executing on profitable growth, expanding their reach, innovating in key areas.
Yeah, the journey ahead involves navigating those macro factors, turning partnerships into steady growth. But the foundation from FY25 seems pretty solid.
Definitely robust. Now, remember everyone, the information shared here is purely for educational and informational purposes.
It is absolutely not financial advice.
Always do your own due diligence. So here's a final thought for you to consider. How might the ongoing consolidation in the enterprise software world actually impact Nutanix's second inning strategy with VMware displacement over the next year or so? Does it help or hinder them?
Good question to ponder.
Something for you to explore. Thanks for joining us on the Deep Dive.